Sumaira, you've always been working very hard for money. Now it's time for money to work hard for you, and that's going to happen through compounding. Let me give you a choice, Sumaira. If I give you 5 crores today, would you take that? Or if I give you 1 rupee, which doubles every day for the next 30 days, which one would be your choice?
I think I'm definitely going to go for 5 crores.
You have made a wrong choice again.
No.
1 rupee, if it had the power to double every day, it would transform itself from 1 rupee to an unbelievable amount of 53 crores in just 30 days.
Wow.
This is the power of compounding.
Wow. When you put it like that, I won that 1 rupee for sure. So clearly compounding is one of the tools to multiply your wealth, and it's certainly one of the most underutilized tools. What it does is that it reinvests your money, and for that you need to give it time.
For all those who are making a choice just like Sumaira did to let go of compounding, let me assure you that there is inflation which is trying to erode your wealth on a compounding basis, so we don't have a choice as investors but to take the benefit of power of compounding.
And if you want compounding to work for you, there are 3 things that you need to take care of. One, of course, is that you have to choose a time frame as long as you possibly can, because compounding works best over longer time frames. Second, of course, is that you need to reinvest your money. You cannot choose to actually take your interest off and enjoy it or spend it. So reinvest that money. And third is our favorite, which is that choose assets which give higher returns.
And choose assets which actually have a one-time taxation at the end as against taxation paid every year. Let's take an example of a fixed deposit and a debt fund, which are comparable instruments. Let's assume both of them have the same rate of return of 8% and the same rate of taxation of 20%. Fixed deposit will need you to pay tax on a yearly basis, and a debt fund will require us to pay tax at the end when the money is taken back.
If you leave this money for 20 years, 100 rupees will transform itself in a fixed deposit after yearly tax payment to 346 rupees. If you defer your taxation for 20 years in a debt fund, the same 100 rupees will grow to 387 as against 346, giving you 41 rupees more because of having compounded the tax amount for the subsequent 19 years.
Well, clearly, as they say, the one who understands compounding benefits from it, and the one who doesn't pays for it. So I hope you have understood compounding.
Of late, several phones actually have this feature of face recognition, right? I think that's because of customer safety. In the mutual fund industry, from a customer recognition perspective, there's something called the Know Your Customer, abbreviated as KYC, so that the mutual fund company actually recognizes you, and an in-person verification helps and facilitates that.